Welcome to the corner of Mr. Field's beautiful basement. All right, and we are going to pick up where we left off. Credit card advantages, credit card disadvantages. So we talked about these things. And now we're going to look at sample credit card statement. You ready? So, April 19th statement. So the first thing we have is our statement date. It's for about a month. You see, March 8th of April 5th. Stacy Casey, that's Stacy Casey. That's the person's name. New Balance. That is the amount Miss Stacy Casey owes the bank. She can pay $15, but if she pays $15, that's not gonna help anything. Okay. You see her previous balance was $665. She can make $15 payment. She purchased these much, that much is what she purchased this month. And now, so you see what Miss Stacy Casey did was she's paying $15, and then she's spending $278. She thinks she has free money, and now she has $936 balance, and she has a $3,000 limit. So Miss Stacy Casey thinks she has $3,000, but she does not. She's just the bank is willing to give her $3,000 borrow, but she has to pay that back. And it's kind of a trap here because they're only requiring her to pay $15, so she's gonna think she can keep spending. Okay, and so I just wanted to go through that a little bit. You can see that basic. Okay, so this is another important part. You can see these are her transactions. So she went to ABC stores, Cafe Express. These are the different stores that she went to. Pay Fitness USA. Look at that. She spent the night in a hotel, went to the pharmacy, bought some movies online, all normal stuff. And whoa, $278 on stuff I didn't need. Yeah. And then her credit card interest rate is 15%. That is that is, an example of a credit card statement. So what you could do is take this statement, read it, and then try to fill in this sheet. So the transaction description, that would be right here. The date, find the date, put that right there. And the transaction plus or minus, balance, and then the total debt. So see if you can take that credit card statement and translate it into the Savvy Shopper tally sheet to see if you get an idea of what she did. At the bottom it says food, jeans, headphones, shoes, and concert tickets. I don't know what that is, so we're gonna ignore it. Okay, but basically what I'd like you to do on these two sheets is to see if you can clearly read the credit card statement. Okay. Lastly, on this little segment is credit scenarios. So we're going to read this together. Read the following scenarios carefully. In each scenario, find either one advantage or one disadvantage of using credit. Circle the advantages and underline the disadvantages. Scenario 1. Before the Gonzalez family went to Walt Disney World for vacation, Mom decided to put most of the money the family had allotted for the trip into a savings account and not carry it with her in the amusement park. She then wouldn't have to worry about losing it or having it stolen. She would use her credit card to pay most of the expenses and then pay for the trip in one lump sum when the credit card bill came. Okay, so in each scenario, find one advantage or one disadvantage. Circle the advantage, underline the disadvantage. What do you guys want to circle? I think we should circle that she wouldn't have to worry about losing her money or having it stolen. Is that a good reason to use a credit card? Absolutely. That's a great reason. And also, we are told in the commercials that if your credit card is stolen, you are not liable for those fraudulent charges, which is another helpful thing. All right, let's see if scenario 2 has some disadvantage. Let's read it. Mario left for college and was excited to be on his own. He received several credit card applications and decided that having one card would be helpful when he was away from home. After receiving the card, Mario found it easy to use and started impulsively buying things he thought he really needed. Soon his bill was up to the limit, and someone had to pay it. His parents were not happy with him. What do you guys think? Disadvantage or advantage? I think it's obvious this one is a disadvantage because Mario accidentally basically he started spending impulsively. So Mario said, I need this and I have a credit card so I can get it. But he didn't actually have the money to pay for it. And then when the bill came, he didn't have any money to pay the bill. So it was a bad situation for Mario. All right, Ricardo, let's see what you got. Ricardo bought a used motorcycle with a small loan from his credit union. He made regular monthly payments of $180 for 3 years until he had it paid off. When he received the motorcycle title, which means that it's his motorcycle, not the bank's anymore, and final paperwork and looked them over, he realized that with interest added, he had paid the credit union $140 more for his motorcycle than he would have had to pay. So this one is obviously they are saying that he had to pay the credit card 140 more than if he had paid in cash. So we could say that's a disadvantage. But I think that we should also circle that he was able to pay it off, you know? So Ricardo, I don't think that he had the money. So for 3 years he paid $180. So what is that? What is 180? 180 times 36. So his motorcycle was $6,480. And I don't think he had that much, but I think he could afford $180 every month. And also, if he only paid $140 more, well, that's actually not bad because his motorcycle was $6,480. So just paying an extra $140 for something he could afford, that's pretty good. Ricardo, I don't really think that's bad. But, when you do borrow money, you do have to pay more. Scenario 4, Rolanda and her best friend were each given a trip to Europe when they graduated from college. They calculated their expenses and planned on taking a small amount of cash and paying for everything else by check. Seeking advice from their bank, they were told that a credit card would be a better option because it would be accepted for payment in many places that would not take personal checks. Well, why don't you pause the video on this one and circle what you think the advantage is. Okay, let me show you what the advantage is. They could use the credit card because it was accepted payment. The personal checks cannot be taken everywhere, but your credit cards are everywhere you want to be, right? Visa. All right, last one. Randy uses credit card to buy a watch that later stopped working. He returned to the store and was given a replacement that also didn't work. He decided he wanted his money back instead of another watch at the same time. He was told the problem could be easily taken care of because he had charged the watch. He was given full credit on his credit card account for the price of the watch. All right. He was told the problem could be easily taken care of because he had charged the watch. All right, so that's an advantage, right? Easily taken care of. So the point there is that, and we're going to write it down, the credit card is proof of payment. Let's say that Randy had used cash to pay for it and lost the receipt, then he couldn't take it back because there was no proof that he bought it and it's broken. And the store doesn't want it back anyway. So, but because he had used a credit card, boop, there's documentation that he did buy the watch and it's broken. So there you go, credit versus debit. And now we have one more lesson before this segment of JA Finance is over. And it's debit and credit, lesson 4, managing credit. Okay, so you should be on page 56, and it's just one page, but we are going to read it because managing credit is super duper hard. Ready? You may know about the consequences of bad debt, but do you know the benefits of good debt? When a debt is paid on time and with no missed payments, the action reflects positively on a consumer's credit. When credit is used responsibly, it demonstrates to lenders that a consumer is creditworthy, that he or she has used credit successfully with a history of bills on time. Maintaining a good credit record is important. With it, consumers can get loans for houses, cars, boats, and home improvements. Still waiting on my boat. Lenders need a way to understand the financial risk of issuing a line of credit. Credit reports and credit scores are two ways prospective lenders assess the likelihood of a consumer loan being paid on time and in full. A credit report determines a consumer's creditworthiness. It details personal and financial information about a person, including existing loans and credit accounts, any late payments, and recent inquiries from other creditors. It can only be obtained by prospective lenders with the borrower's permission. A credit score is a numerical expression of a person's creditworthiness and is based on the information in a credit report. Lenders may seek scores from more than one agency depending on the credit being applied for. Credit reporting agencies keep records on a consumer's credit experience. The credit report includes information on where you live, how you pay your bills, and whether you have been sued or arrested, or if you have filed for bankruptcy. Nationwide consumer reporting companies sell the information in your report to creditors, insurers, employers with written consent, and other businesses that use it to evaluate your applications for credit, insurance, employment, or housing. Simply put, if you are a responsible borrower, you will have a good credit rating. If not, you will have a poor credit rating. Whether to use credit is an important decision. All right, so that's something you should. And so let's look. Our vocabulary is a credit report and a credit score. And so you can do that. So go ahead and record 3 takeaways that you got from my reading of lesson 4, managing credit. And then we will be moving on to our last segment. Right. Bye for now.